which is that the credit markets remain closed even as the stock market has resurrected itself for the day. Joining the conversation with us now from Dover Capital, Doug Cliggott, or Dover Management, excuse me. Doug, once the Chief Investment Strategist at JP Morgan, now running money at Dover, has been for some time. Most importantly, this is a man who has been very aggressive and consistent in cautioning as to the liabilities of allowing for limited lending standards, which started in '99, and high leverage, which was exempted to 40-to-1 in 2004, that would lead to a situation not dissimilar to the one we are talking about tonight. Doug, one of the worst ways to be right, I suppose, is this way, but it certainly warrants conversation with you. Now that we have the chickens coming home to roost, as it were, I'm curious how you are managing your money.
Well, I guess needless to say, doing very, very cautiously. But I think if I can weigh in just a second on the $700 billion plan, $700 billion is a huge amount of money when we compare it to almost anything on the planet. But unfortunately, it isn't that much money when we compare it to the balance sheet of the U.S. financial sector. If you look at the Federal Reserve's own data, at the beginning of this year, assets in the U.S. financial sector were $62.7 trillion. So $700 billion is a little more than 1% of that. Now we've moved, what, about $5 trillion of that from the private sector to the public sector, with Fannie and Freddie being nationalized. But I'm scratching my head. I don't understand how buying $700 billion of assets on, say, let's call it a $55 trillion balance sheet is suddenly going to mean our financial system has enough capital and can start,
Well, but the argument, I mean, let's just explore that for a second, because I don't know that it's being presented as enough capital to basically replace that which would be lost from the decline in the housing market and what we didn't have on the insurance and all the rest of it, but that it will jumpstart the credit market so that we can simply have a functioning lending market as we then endure a period of time, likely years, in which we work off that bigger multi-trillion dollar number that you fear. Are you skeptical of the ability to even start the credit markets with amount of money of that size?
Well, I think, Dylan, we know there's hundreds of billions of dollars of liquidity in the market right now being supplied by the Federal Reserve. They just, upped the ante in a dramatic way again yesterday. But I think so. I don't think liquidity is the issue. I think on the lending side, it's capital. I think most big lenders don't feel they have enough capital. And I think on the borrowing side, we all want the credit engine to start running. But I think the reality is millions of borrowers already have too much debt. So who out there wants to borrow money to do something that feels like they have the capacity to borrow tons of money at this stage? There might be some companies, but I don't think there's many households. I'm sympathetic to the idea that we've got to unlock the financial system. Of course we do. And I think the move to increase the limits on insurance on deposits is a great idea. I wish they'd push it a lot higher. I think we need some confidence back in the banking system. But again, I'm struggling. Okay, we go in the market, we use $700 billion, we bid above the current market price for some assets, we take those onto the public sector's balance sheet. What happens? What comes next to suddenly, get this engine running?
So let's say we go with cold hard facts and accept the fact that the value of the American housing stock is collectively owned by 300 million people and a bunch of banks, and it's worth whatever it is, some tens of trillions of dollars, and that it's not worth what it was most recently bought for as a collective, and it needs to be made worth less. The market has to take it down, and the banks own more of that, unfortunately, than the people do, is the truth of the matter, which is why the banks are collapsing. I'm curious if I make you in charge of everything. Yeah, no one wants that job, do they? Now you're a little more. Everybody's a little more sympathetic to Hank Paulson all of a sudden. But how do you do that?
Well, again, let's look at the numbers. There's $14 trillion worth of mortgages out there.
Right.
Right. $14 trillion.
We think.
Well, at face value,
They're not pricing a lot.
that's where they were.
Right, but let's presume everybody understands the problem. The problem's immense and we can all get it.
Well,
you're an investor and have to move forward, Doug.
What I think you do is there's no reason to try to pick the bottom in financial stocks, Dylan. I mean, on many different metrics, if we look at the operating earnings of financial companies through the second quarter, that's the latest data that we have, that level is still more than double the average of what it was in the 80s, in the 90s. I think, thinking that this is an opportune time to buy financials because somehow we're going to transfer, public money to the private sector, I could be dead wrong on this, but I think it's consumer staples, it's healthcare, it's defensive, it's careful, because even if we do get a big plan in place, credit growth leads earnings growth by 6 to 12 months. So we're going to be looking at horrible earnings data well into next year, even if some grand plan gets passed tomorrow.
Let me just ask you a question, just to play devil's advocate. The $14 trillion of mortgages that you talk about, I don't know if that was mortgage.
Face value.
Face value, all right. So really, the overwhelming majority, and probably something in the 90% of that is probably money good. You're going to have on the very low end the subprime or the high loan to value ratio or the option arms that, reverse. All of those, let's say those are bad. So that when you start to look at that $700 billion, to say it's on 14 trillion or 55 trillion of the number of financial assets that you threw out earlier is really kind of, I think it's somewhat misleading. It's really the $700 billion addressing the amount of the undercapitalization or the amount of the problems, not the total existence.
But do we really think the problem is just a small subset of mortgages? Aren't there issues with auto loans?
Yes, I do believe there are issues with auto loans, but when you talk about that 55 trillion of assets, let's say financial assets overall,
yes,
which is I think what you started with,
yes,
what do you think is the amount of problematic assets of that 55?
Well,
let's just say 10%.
Put it all together.
That's okay, so that...
okay, let's say 10% for argument's sake.
So 10% defaults for every boat, Harley Davidson, car, house in America because they just can't pay their bills.
So hopefully that's way overestimate.
Sure.
So that's 5.5 trillion. We started the year with 4.6 trillion of equity capital in the financial system. So now we're in deficit by almost $1 trillion, 900 billion, if that's the right math.
Okay.
And again, I hope it's not the right math.
But if it is, that 700 billion starts to be a much bigger number, is my point.
If it were going in as capital, absolutely, it would be a huge number if it was going to be used as capital to support a balance sheet. My understanding of the plan is we're going to use it to buy assets, and so that some fraction of the mismatch between what we pay and how they're valued will go to the bottom line and be capital. I don't think anyone's talked about using $700 billion as an equity capital injection into the financial system.
Yeah. All right. So your bottom line, if I subscribe to the way you've analyzed this, is to play total defense to avoid the financials altogether, and if you're going to be long anything, long consumer staples. Is that fair to say, Doug?
It's healthcare and consumer. Because, Dylan, I think there's still a lot of bad earnings news ahead of us. I'm rooting for a solution. I'm just skeptical that we've identified one.
You're having a hard time with the math. I get it.
I really am.
Yeah, I get you. Thank you for sharing it with us. As difficult a conversation as it is to have, if we don't have it, we can't solve it. We'll take a break here. We are back with John Nigerian on why this is not a Wall Street.